Hi, welcome to Search for Yield, the weekly newsletter from INR Bonds. I'm Arjun Patsati. And in this week's Search for Yields, we speak about staggered maturity bonds and how they are very good investments in this current rising interest rate scenario. Now, those of you following INR bonds research and bond bites and all podcasts and our post-budget analysis, we have clearly mentioned over the last 1 year at least that interest rates are rising and investors have to be positioned for rising interest rate scenario. And with the budget showing excessive supply of bonds, then the interest rates are going to rise. We are definitely in a rising interest rate scenario, and clearly, I think that's where the investors have to position for their portfolios for, and financial advisors have to advise investors on the right bonds or the right products to mutual fixed income products to invest in rising interest rate scenarios. Now, one of the best investments in rising interest rate scenarios are staggered maturity bonds. Now, staggered maturity bonds are bonds where the issuer pays the principal in a staggered manner. Now, just for example, let me give you an example where an issuer has issued bonds. And let's take an investor has ₹100 face value of the bond. Then the issuer, after a certain period of time, for example, 3-4 years, will start to repay the principal in different percentages. So if it's a quarterly interest payment every year after the 4th year, then every year the issuer will pay the principal of 25% every year. And over the next 4 years, all the principal will be paid out. So let's assuming that the bond you have invested in a 5-year bond, a staggered maturity bond, and the terms are that in the last 3 years, after 2 years, or in the last 3 years, every year the issuer will let's take it 6 years then. In the last 4 years, after 2 years, every year the issuer will redeem 25% of the principal. And let's take the coupon as 10%. So in this case, after 2 years, in the 3rd year, the investor will get back ₹25 of principal. And for the next year, the interest he'll get is just it is 10% of ₹75 because the face value of ₹100 comes down to ₹75 on payment of ₹25. In the second year, it will be ₹50 as investors gets ₹25. And in the 4th year, then the 3rd, 4th, in the 5th year, the investor will get another 25, and in the 6th year, another 25. And every year, the percentage, the interest payment, well, the coupon remains the same at 10%, but the interest paid out will be lower because the face value of the bond reduces. But the best part here for the investor is that they get back the principal faster, reducing their risk. And also, when principal is paid out, then even though a bond is issued with a maturity of 6 years, the duration, which gives you the time to maturity of the bond, that reduces, and this reduces the interest rate risk. So with this, what happens is that here the investor is definitely in one sense protected because they get the principal back fast, and they're protected from credit risk, and also they're protected from interest rate risk, given that lower average maturity or lower duration, as we call it in bond market terminology. The staggered maturity bonds are good in rising interest rate scenarios, not in falling interest rate scenarios. So if interest rates are falling, for example, then nobody wants the money back fast because they are locked into higher coupons, and they would rather get full higher interest rates, even though interest rates are falling. and not worry about reinvesting the money at lower interest rates. But when interest rates are rising, then here it's a very good opportunity, a good investment for investors, as the principal is coming back faster. And once the principal comes back fast, then the principal can be reinvested in higher yielding bonds because interest rates would have gone up and the principal is paid out. So the interest rate investors pretty much getting a good deal in investing in a staggered maturity bond. And just to give you some examples of staggered maturity bonds, we have bonds like Swatantra Microfinance, which pays out, I think, 25%. Then you have UPPCL that pays out 12.5%, I think, on Swatantra Microfinance. We are giving you the details here, but as you can see that all these bonds are redeeming the principal in a staggered maturity, and especially if it's a very short-term bond, then in if the interest rates are going to rise in the next 1 to 2 years, then these short-term bonds pay out principals quicker in a quarterly manner, for example, and then you just get you can reinvest all those principal payouts because yields would have gone up in bonds, that is, interest rates would have gone up in bonds, and you can reinvest those bonds at higher interest rates. Even actually, you can even reinvest in the same issuer, which has a longer maturity, where the interest rates would have risen. So this makes a very good investment for rising interest rates, especially if interest rates are looking to rise in the next 1 to 2 years. And if you find bonds available for 1 or 2 years with staggered maturity, then they make very good investments. Thank you for listening. And you can find staggered maturity bonds in our Quick Invest by INR Bonds app. All you need to do is download the app on iOS and Android and get into the app, and you'll see the staggered maturity bonds, and just click to invest, and you just can invest in a straightforward manner. All the information on the credit, on the issuer, on the risk, etc., everything is given, and all you need to take is your own investment decision. Download the app now, and if you've not subscribed to our YouTube channel, please do so, and do press the like button. Thank you.